Mahesh, if one really looks at last 2 quarters, we've seen not too many big upgrades, couple of downgrades, and in general, markets have not seen any big earnings surprise. Are we in for more of the same? Where based on your interaction with companies and your understanding of demand and growth dynamics, we could be in for perhaps two or three lull and dull quarters of earnings.
That is quite possible, Nikunj, because we've had a very strong growth over the last couple of years. This year, yes, we have seen some earnings revisions on the downside. And the June quarter, the attribution that was given to was the election-related activities and hot summer, etc. This quarter, it seems like the rains that have been higher than last year have had some impact. So there are a couple of reasons like that, but the end result is that probably we are going to be seeing some earnings revisions on the downside. But as I said, having said that, the growth numbers are still looking reasonably good. The key question here, Nikunj, is that when we talk about the growth outlook being good and relative positioning being strong, etc., how much of that is already factored, by the market? My sense is that the strong surge in the domestic liquidity has made the markets quickly factor in the growth outlook that we are kind of talking about. So maybe a couple of quarters, 2, 3 quarters of market moving sideways, or maybe a small dip, etc., is quite likely. And if that were to happen, I would actually take it as a healthy time correction, because the earnings growth, as I mentioned, is about 14% or so. So even the market remains flattish for the next 1 year, the valuations improve by 14%, which would then begin to look more attractive.
But the bedrock on which markets are going up is this insatiable appetite for equities, whether it is retail, HNI, or even global investors. But in your recent strategy note, which is 13th of September 2024, the observation what you are making and what you essentially are making a case is that unsustainable demand flows a challenge, which means are you making a case that the kind of liquidity which is coming from domestic investors and domestic participants into Indian stocks will not sustain?
See, if you look at just the macro numbers in this current calendar year, 2024, for 8 months for which we have the data for, the the average domestic inflows into equity markets been at $7.5 billion a month. The good part is a dominant part of that is coming in by way of mutual fund flows, but still the absolute number of $7.5 billion is huge. If you were to annualize that, we're looking at $90 billion per year kind of an inflows. And that accounts for about 25% of gross financial savings, about 35% of net financial savings. Now, these kind of percentages, 25 or 35%, is something that we see in developed world. So clearly, to that extent, I believe that the flows that we're seeing are at an unsustainably high level. And there is a good possibility that we trend down towards a more sustainable number, say around $4 to $5 billion. So yes, I am making a point here that the domestic flows at the current pace appear unsustainably high.
There comes a time when your heart calls for you to arise. Plant your feet solid into the ground. Decide your own limits. And then break right through them. Become something more. It's my time to rise.